looking at a localized failure in global financial compliance, isolated within the sovereign tax frameworks of the United States Virgin Islands. This was not a standard offshore wealth management operation, but a fully autonomous correspondent banking conduit. By leveraging the territory's Economic Development Commission incentives in 2012, a single entity established the Southern Trust Company. This structure granted direct, unmonitored access to top-tier institutional clearinghouses. The architecture effectively bypassed standard anti-money laundering node verifications. The mechanical advantage of this system relied on exploiting specific regulatory blind spots within domestic transaction routing. Funds did not move through conventional retail banking layers. Instead, capital was classified under bulk institutional transfers, masking individual beneficiary data beneath aggregated corporate identities. Over a single decade, internal compliance algorithms generated suspicious activity reports flagging approximately $1 billion in irregular capital flow. Yet, these alerts were consistently overridden at the executive level. The infrastructure required a primary financial artery to interface with global markets. Between 1998 and 2013, JPMorgan Chase maintained over 50 interconnected accounts tied to this specific private network. The ledger data from these accounts represents an unfiltered chronological map of high-velocity capital redirection. Every wire transfer, offshore entity capitalization, and private liquidity injection was processed through this centralized institutional hub. The bank acted as the vital mechanism, converting isolated offshore funds into internationally recognized liquid assets. When the systemic loopholes became a legal liability, the immediate corporate response was institutional silence. Rather than proceeding to a public trial and submitting raw, unredacted transaction ledgers into the public domain, the compliance strategy shifted to risk containment. In June 2023, JPMorgan Chase finalized a $290 million settlement to resolve class action litigation regarding their operational role. This financial penalty was calculated and absorbed as a standard operational cost to preserve ledger opacity. The settlement effectively sealed the foundational routing data, ensuring that the specific recipient nodes remained outside judicial scrutiny. Forensic analysts categorize this as a jurisdictional firewall, where capital volume outpaces the jurisdictional reach of regional regulators. The Southern Trust Company was eventually stripped of its tax benefits, but the transactional history had already been secured behind corporate non-disclosure agreements. What remains visible is only the architectural framework of an unverified node transfer system. The actual capital distribution network is permanently localized in redacted corporate archives. The structural integrity of the shadow ledger relied on deliberate fragmentation. Capital entering the primary clearinghouse was immediately subdivided across multiple subordinate entities, notably JES St. Thomas LLC and the 1998 Trust. These accounts functioned as terminal nodes, preventing automated compliance algorithms from establishing a stable behavioral profile. The system operated entirely within the noise of global daily transaction volumes. Internal risk management protocols were fully aware of the operational anomalies. Between 2006 and 2019, compliance personnel generated numerous alerts regarding unverified, high-frequency withdrawals exceeding $100,000 per transaction. These localized liquidity events triggered mandatory threshold warnings, yet the automated hold protocols were manually bypassed by senior account managers. The regulatory friction was neutralized through executive mandate rather than procedural verification. The physical off-ramping of these funds required a highly insulated geographic node. The United States Virgin Islands provided the optimal environment, combining domestic banking access with offshore regulatory opacity. Millions of dollars were routed from top-tier institutional accounts directly into localized, low-visibility regional banks. Once the capital crossed into the territorial grid, it was insulated from federal-level forensic audits. The operational survival of this conduit depended on high net worth transactional gravity. The ledger actively processed multi-million-dollar capital injections from external fiduciary networks. When compliance officers attempted to classify the account as a systemic risk, the sheer volume of managed capital was utilized as a countermeasure. The profitability of the node created a structural disincentive for investigation, prioritizing revenue retention over regulatory compliance. The eventual collapse of the network was not initiated by internal regulatory adherence, but by external legal catastrophe. Once the primary operator was compromised, the institutional shield was immediately retracted, exposing the raw transactional data to federal subpoenas. The resulting forensic reconstruction revealed a 15-year pattern of documented compliance negligence. The architecture operated exactly as engineered until the external legal liabilities permanently eclipsed the operational margins. The ultimate systemic closure was not achieved through kinetic raids, but through localized bureaucratic arbitration. In late 2022, the government of the United States Virgin Islands formalized a $105 million settlement directly with the estate of the primary operator. This financial agreement effectively liquidated the remaining regional claims without requiring a prolonged public trial. The arbitration process ensured that the deepest structural mechanics of the Southern Trust Company remained outside the domain of open court transcripts. The territory absorbed the capital injection, permanently closing the localized audit. The parallel risk containment strategy executed by the Tier 1 clearinghouses followed an identical fiscal logic. The massive institutional settlements, specifically the $290 million absorbed by JPMorgan and the $150 million extracted from Deutsche Bank, were not punitive anomalies. Financial auditors classify these massive disbursements strictly as the cost of doing business within high net worth fiduciary networks. These calculated operational losses were paid specifically to establish an impenetrable firewall. The capital surrender guaranteed that the raw, unredacted transaction ledgers were permanently sealed from external judicial discovery. What remains accessible to federal oversight is merely a highly sanitized summary of the aggregated corporate identities. Teams of forensic accountants and compliance attorneys spent years systematically redacting the specific beneficiary nodes prior to the final settlement ratifications. The sheer volume of the obscured documentation functions as a structural deterrent against further forensic reconstruction. The actual capital distribution network was never dismantled by regulators. It was simply legislated into a state of permanent ledger opacity through non-disclosure agreements. The most critical failure in this compliance architecture is its ongoing viability within the current global grid. The entire infrastructure was legally anchored in specific family office regulatory loopholes, which exempt certain private wealth management entities from standard institutional reporting requirements. As of today, these localized exemptions remain largely unpatched by federal legislative bodies. The systemic blind spots that facilitated the routing of $1 billion in unverified capital transfers are still mathematically active. The Southern Trust Company was merely a single, autonomous node exploiting a standardized operational vulnerability. The architectural blueprints for this unverified distribution network remain fully functional for any entity with sufficient capital gravity to activate them. The systemic risk was never eliminated, only rebranded and relocated to other compliant jurisdictions. The financial pipeline continues to process high-velocity capital redirection entirely outside the peripheral vision of standard regulatory algorithms. Subscribe to Leviathan Files. Stay curious and remember, the truth remains permanently redacted.